Perfect. Well, thank you. First, Ian, I want to say thank you for having me. I'm thankful to be a part of the community and to network and build relationships with other investors, many of whom have become my friends. And I want to give a little bit of background on Pinnacle and myself, and then we can dive into our investment process and finish with a stock pitch of Quest. Starting with Pinnacle, Pinnacle was a hedge fund for 17 years from 94 to 2010. And Pinnacle had exceptional performance over that time period and averaged 24.11 net annually with one down year in '08. And Pinnacle closed to outside money in 2010 and became a family office, and it's been a family office ever since. The PM of the hedge fund, Barry Kitt, wanted more quality of life, but he didn't slow down at all, and he works just as hard today as he did back then. In 2014, Greg Kitt had finished cutting his teeth at a hedge fund in San Diego, and he came to join Pinnacle. And then lastly, I've had the privilege of working with Pinnacle since January of 2019. And today, Barry, Greg, and I run our investment portfolio. So a good place to start, I think, when we're going to talk about our process is how do you find ideas? And so I would love to say that this is easy, but at least for us, it takes a lot of work. There are generally three ways that we find ideas. First, we take a lot of meetings. Every year since joining Pinnacle, we've taken over 300 unique meetings with publicly traded companies. So we turn over a lot of rocks. It's been incredibly helpful in building out a library of knowledge for industries, for business models, for competitive landscapes, et cetera. And so before every meeting, we build out a stub model and we create a list of questions. And then after every meeting, hopefully we underwrite the investment opportunity. Second, I love monitoring the syndicate calendar, which has been an incredible idea generator for us. We participate in IPOs and follow-on offerings. And historically, that's been the number one idea generator for us. Obviously, the syndicate calendar has been very quiet this year. But third, lastly, when we meet with and subsequently underwrite a company, we frequently will find a great company or a good company with a great management team that just has an expensive price. And so what we do is we monitor those companies consistently with the hopes that we can get involved at a better price. And so let's talk about how we analyze the companies that we do find. So generally, I like to say we're trying to find great businesses with great management teams at a great price. I have the most to say in this context about great businesses and great prices, but regarding great management teams, we're looking for people of integrity. And that seems obvious, but that's hard to evaluate without spending time with management. It also probably can't be done in one sitting. And so we evaluate management teams by spending a lot of time with them and by trying to gauge how well what they say aligns with the numbers that they're reporting. And then for great businesses, everyone on our team has a slightly different process for analyzing businesses. I want to share mine and a tool that my colleague uses has been so helpful to me. But you'll see this question on FinTwit frequently, but someone will inevitably ask, if you could ask a management team just one question, what would it be? And I'm going to cheat and I'm going to say that I have two. The first thing that I want to understand is a company's value proposition relative to the competition. That's super obvious, but it helps us understand why companies grow and take share. And we try to own companies that are the best at what they do or have something about them that uniquely positions them in their competitive landscape. As it pertains to the unit economics, which is the second thing I want to understand, I want to understand the economics for all the parties in the ecosystem, principally the customer and the company. For the customer, unit economics are important to assess the value proposition, obviously. I want to know what the product or service costs the customer. Does it save the customer money? How does that compare to the competition? And, if we're going to purchase something as a customer, is there a return on that investment? And then unit economics for a company are also important because I want to understand the incrementals of the model. So we love investing in businesses with high incremental EBITDA margins. And so understanding the unit economics is really important to that. I want to share a little bit of a mnemonic device for our process. The acronym is MERIT. It's super easy to remember because we're looking for investments that have merit. And so one thing to add here is that there's no order or ranking. It's just the way it's spelled. And so if I can dive through it real quick, M is macro, so overarching trend in the industry driving growth. E is estimate, so how is consensus positioned relative to our model? R is relative valuation. Is there room for multiple expansion relative to comps? Intrinsic valuation. Is the multiple that we're underwriting with cheap on an absolute basis? And T is trackable. So the best advantage that you could have is an information advantage. And so can we find a public data set that allows us to track the company's performance intra-quarter? And then S is safety. So do we trust the management team? So if we can find strong industry tailwinds, consensus estimates that it seem conservatively modeled, the business trades at a discount to comps, and you're underwriting with a reasonable multiple and you feel like you can trust the management team, that's a great business to own, and I will take 10 of those. In terms of assessing great price, as I mentioned, we like to think about valuation on a relative and absolute basis. We keep an underwriting sheet for all of our investments and all the positions that we monitor most closely on our watch list. And we underwrite to a 40% IRR just because stuff happens in small cap land. And so on the next slide, I have a screenshot of our underwriting sheet. This is it. This is helpful for me just to garner the necessary conviction to initiate on positions and stick with them. And we generally underwrite on profitability. In this case, as you can see, a lot of EBITDA 2 years out. And so that's a perfect segue to our stock pitch. I mentioned that we underwrite on EBITDA 2 years out. And so to get everyone's attention up front on the pitch, we think this stock is worth $25 on 24 EBITDA or $21 on a diluted basis. That's a 78% and 64% IRR respectively. And to go one step further, if Quest can grow gross profit dollars 10% or annually and get reasonable multiple expansion, then this is a 10 bagger in 12 years. And that's really exciting to me. So let's dive into that. So first, who is Quest and what do they do? Quest is an asset-light, value-added waste and recycling services provider. Quest helps national customers meet internally mandated and or externally regulated ESG goals at no incremental cost to the incumbent waste management solution. So Quest is asset-light, like I said. It has a network of 3,500 independent waste hauler partners. Quest doesn't own any waste hauling trucks or haul any waste itself. It's asset-light. So Quest earns the difference between what customers pay Quest and then what Quest pays the waste haulers. Because of that dynamic, we like to think of their gross profit line as net revenue. And then importantly, Quest will provide waste volumes and sustainability data back to the customer to inform three things: internal analysis, ESG reporting, and then external regulatory reporting. So now that you know what they do, let me give you some history. Prior to 2016, Quest was growing for the sake of growth, little focus on profitability. Quest had millions of dollars of negative gross margin revenue. In 2016, Ray Hatch, Quest's current CEO, joined. And when he joined, he embarked on a mission to eliminate negative gross margin revenue and position the company for profitable growth. From 2016 to 2020, as you can see in this picture, revenues were almost cut in half, but gross profit dollars grew from 14.4 million to 19.1 million. And EBITDA dollars grew from negative 1.5 million to positive 4.5 million in 2020. Quest grew organically for the first time under Ray's leadership in Q4 of 2020 after shedding all of this contractual multi-year negative gross margin contracts. Today, Quest is currently growing gross profit dollars 22% organically first half over first half. So let's talk about the macro trend that's driving that. The key trend here is landfill diversion. So what's landfill diversion? Why is it a big deal? When your trash gets picked up, and even when a lot of your recycling gets picked up, it ends up in the landfill. There are a lot of reasons for this, but principally, the asset-heavy companies, affectionately known as the Big Three, Waste Management, Republic, Waste Connections, they all own landfills. And when haulers take waste to the landfill charges tipping fees that have 45 to 70% EBITDA margins. Those margins are much higher than any other segment of their business. And so they have a lot of incentive to continue to take waste to the landfill. However, states are increasingly regulating what you can and can't send to the landfill. This isn't just a California thing. It's being done in other states across the country. For example, if I can just take one of the over 100 waste streams that Quest manages, Let's take food waste, for example. There are at least 8 states that have restrictions on sending food waste to the landfill. So why are states doing this? First, landfills are the 3rd largest producer of methane gas. And second, when landfills get rained on, it creates wastewater. And what you don't want is for wastewater, which has harmful chemicals referred to as PFAS, you don't want that wastewater to seep into groundwater and your rivers because it gets in the crops that we ultimately end up consuming. And that's why states are regulating landfill use. So in addition to regulatory drivers, companies have taken it upon themselves to divert waste away from the landfill. I'm sure that we've all seen companies issue their inaugural ESG reports over the last couple of years. And one of the key items in an ESG report is landfill diversion. And so now that you get the big picture theme, let's talk about the value proposition for every member of the ecosystem, starting with the customer. So Quest customers get at least 5 benefits from working with Quest that all come, again, at no incremental cost to working with the asset-heavy competition. And so first, Quest is aligned with their customer. Quest doesn't own any landfills, so Quest doesn't have the incentive to take everything to the landfill. They have the incentive to meet the customer's needs. Second, Quest performs waste audits at customer locations. Quest will right-size waste pickups by changing the size of the waste container or the frequency of the pickup to reduce service costs. And so reduced waste pickup frequency results in cost savings to the customer. And then thirdly, and this is really key, Quest will compile waste volume data and provide comprehensive reports by waste stream back to the customer. And again, companies use this for the 3 things we talked about. Internal analysis. Let's give an example. Let's take Quest customer Kroger as the example and take 2 grocery stores that are the same size. Why is one grocery store generating more waste than another? Does one store have too much inventory? Are they over inventory? Or do they have too little inventory? Do they have a spoilage problem? Do they have a busted fridge that's causing that spoilage problem? And that's manifesting itself in the waste data. Other 2 ways companies use this data, they'll use it to inform their ESG reports, and then they'll use it to show regulators that they're meeting the regulatory requirements. 4th and 5th here, the customer benefits from vendor consolidation. Frequently, companies work with numerous vendors to meet all of their recycling and waste needs. Quest, if you'll excuse the expression, is one throat to choke. And then 5th, Quest will share salvage value of commodities with the customer. So that's the customer. What does the hauler get out of this? The most expensive thing a waste hauler can haul is air. Why is that? Well, waste haulers have a high fixed cost business and they get paid on volume. So Quest has a symbiotic relationship with their haulers. Quest can bid for contracts nationally that small mom and pop regional haulers could never bid for. Quest gives haulers business they'd never win on their own at really high incremental margins because Quest is going to increase their utilization and their route density. In return, the hauler is going to give Quest preferential pricing. So what does Quest get out of it? Quest gets a recurring revenue stream. It's highly sticky. That revenue stream is going to increase hauler utilization, and that allows Quest to get better pricing. So to some extent, this creates a virtuous cycle. And so now that we have the macro backdrop and understand Quest's value proposition, let's switch to Quest's growth algorithm, consensus expectations, and the unit economics. So Quest has a 3-legged stool for growth, as they like to describe it. It's expanding with current customers, winning new customers, and growing through acquisitions. With their current customers, Quest grows through increased volumes, cross-selling additional waste streams and services. Quest also has been very successful at winning new business and has announced several 7-figure and 8-figure revenue wins over the last year and a half. Additionally, Quest has grown through acquisitions. Quest team is very adept at structuring acquisitions and organically growing the acquired business by cross-selling waste streams to the acquired customer base and then by adding additional geographies. On the unit economics side, real big picture, Quest average customer is 7 figures of revenue that contributes mid to high teens gross margins with 50% of incremental gross profit dollars flowing through to adjusted EBITDA. So this model is all about gross profit dollar growth, and then 50% of incremental gross profit dollars flow through to adjusted EBITDA. Briefly on the consensus expectations, again, Quest is currently growing gross profit dollars over 20% organically. Although that might moderate, consensus expectations currently call for 7.7% growth gross profit dollar growth in 23 and 24. Additionally, like I said, 50% of incremental gross profit dollars flow through to adjusted EBITDA. But consensus implies only 32.5% in 23 and 7% in 24. I think those estimates are positioned super favorably for Quest. So let's cover the valuation next. There are two ways to think about comps here. First, you can comp it against other waste service companies. There are 8 publicly traded asset-heavy waste services companies. I don't think this comp set is very instructive for 2 reasons, principally. The business models are completely different. One's asset-heavy, one's asset-light. And the asset-heavy players have a secular headwind from landfill diversion versus Quest, which has a secular tailwind. However, if you want to use the asset-heavy waste services companies as a reference point, the big 3, Waste Management, Republic, Waste Connections, those 3 trade at 16.4 times 22 EBITDA and 15 times 23 EBITDA. So in my mind, that creates some baseline for a premium. Second, and our preferred method for thinking about comps is similar business models. So we're looking at other small cap companies, asset light companies, multi-year contractual customer relationships with high renewal rates that focus on an enterprise level sale with high incremental contribution margins. That comp set that I have here trades at 11.5 times 23 EV to gross profit and 24 times EV to EBITDA. We underwrite this at 20 times EBITDA. It's in the middle of both comp sets. I think that's really defensible. If we apply a 20 times EBITDA multiple to our estimates for 23 and 24, we compute a $22 and $25 price target respectively. A triple in 2 years is much higher than a 40% IRR. It's a 73% IRR. That's really exciting to me. And then lastly, in the way of disclosure, Pinnacle is a 13.1% holder of Quest. I included our disclaimer on the next slide. And with that, Ian, I would gladly take any questions.